such nonsense. I really despise this debt ceiling stuff. We deal with this debt ceiling crap, I feel like, every year, and it's just such nonsense because it just politicians wanting to make sure that that America knows they're fighting to do the best for what people believe they want their politicians to do. And unfortunately, that means you end up having this brinksmanship and populism and finger pointing and name calling, and I don't know. To some extent, I feel conflicted because our founding fathers wanted there to be gridlock, but then we've also walked ourselves into situations where gridlock sucks, like when it comes to having literal debt ceiling, where which is stupid because it's like authorizing payments twice. It's really dumb if you think about it. It's like, what's the point of passing a bill, agreeing to spend money, if you're just going to end up holding it up in debt ceiling negotiations in the future? It blows my mind. But that's what we have to deal with. So here we are. Now, I mean, I really believe that nobody is dumb enough to actually let the United States economy tank so badly by letting a default occur. But then again, I've seen some pretty stupid things in politics. So I suppose I won't let myself be too terribly surprised. But let's just say I'll continue to be hopeful. I continue to think this is nonsense, the debt ceiling nonsense. I put the odds at default at well under 1%. I know that would be pretty wild if we ended up defaulting, but it seems so widely impossible that I can't see a reason why it would happen beyond just, again, this nonsensical political brinksmanship. I think there'd be plenty of ways the Treasury just ends up figuring out how to stop making payments for a little bit on things that don't matter, like they did in 2011. Then you get a big media spectacle and poop show. If you don't remember 2011, basically in 2011, the government stopped paying like TSA agents and park reps for a while, and everybody was freaking out because this idea was like, wow, man, seriously, government, you can't even pay TSA agents? Like, this is ridiculous. This is a joke. And it was so embarrassing that we had parks basically fenced off, federally guarded parks, like Washington Monuments or whatever. That politicians finally figured it out. But the good news is the stock market is actually doing surprisingly well in the face of all of this. And in my opinion, that's, well, I mean, I don't think I need to say the B word. I think I've already been pretty dang clearly bullish for, I think I was a little early with the bullishness, but I think the Nike swoosh has been something I've been very consistent with, and people have regularly been asking, since really December and January and otherwise, as yields have been high, people have been asking, well, Kevin, why bother being in stocks? I can make 5% on my cash, and it's true, you can make 5%. You go to various different platforms. I've actually resisted talking about where to place your cash to get yield, whether that's I've briefly mentioned it in sort of just lists, like, you can go to Robinhood, SoFi, or you go to whatever. It doesn't really matter. But I've resisted wanting to really make videos about this or try to encourage people investing in a way that they're trying to get just cash yield, mostly because when cash yields are high, you have to consider that you're not really earning 5%, right? So you get a 5% yield at, say, Wealthfront. What are you actually getting? Well, you're getting a real return maybe in the neighborhood of 0%, right? When we factor out inflation. But beyond that, what are you actually looking at? Well, you're looking at, let's assume the inflation doesn't matter to your cash, right? So how could inflation not matter to your cash? What do you mean, Kevin? We've been talking about this for a year and a half on the channel. Inflation doesn't matter to your cash if you're buying assets that are going down in value. I personally, if I have, a household food budget, yeah, inflation is going to make that household food budget go up. But if food represents, I don't know, 1% of our household budget, then, and 99% of my budget isn't affected by inflation because let's say it's going into investing in assets like stocks or real estate or whatever, then if those values go down, then my cash actually becomes more valuable in an inflationary time, not less. But ignore inflation for a moment completely. And let's think to ourselves, if inflation is 0 and we're getting a 5% cash yield, what is the other risk we face with our cash? And this is something regularly people on the, in my courses have been asking me, people in on the channel have been asking, Kevin, why not just put all my money in on 5% cash or treasuries? And the real reality that I think is so quickly missed is this phrase I know everyone here has heard before. Everybody's heard it before. It should come as no surprise. And so if you're surprised by what I'm about to say, in terms of why you're able to get this yield that everyone's excited about, well, it should come as no surprise. And that is opportunity cost. What's your opportunity cost? Well, since January 1st, your opportunity cost of being in cash as opposed to the S&P 500 has been 10%. That means you have earned 10% on stocks since the beginning of the year, and the year's not even over, which means, hey, wait a minute, if we continued at this level, your opportunity cost for a year of the S&P 500 could be 20%, right? Now, of course, with stocks, there's always the risk of the market going down, right? That's the downside. If you're on the ride of stocks, of course, there's a risk of the market going down, and then you could actually have a negative return on your money. But look, for example, at two responses to that. First of all, I want to quickly bring up the NASDAQ. The NASDAQ 100, top 100 technology companies in America, is up 27.6% year to date. That's insane. So, if you're excited about earning 5%, congratulations. In this time, let's see, we're about a full 5 months into the year, right? So we're about 41% of the way in the year, 41.6% into the year. Let's multiply that by your 5% yield. So far, out of 5% annual yield, you've earned 2% all the way through May 23rd. So you've earned 2%. The S&P's returned 10%. The NASDAQ's returned 27%. That's what opportunity cost looks like. Now, yes, is it possible stocks can go down? Of course it's possible, especially since they've already done so well. But something to remember is, and this is the beautiful thing about owning stocks, the problem with options, for example, is you have theta decay. You get slowly bled out, unless, of course, you're a seller of options, which is generally the way to make money with options. You sell options and you become someone who profits off of that theta decay. But anyway, if you're holding stock, you don't have to worry about theta decay. You don't care at all about theta decay. You can just hold the stock and you ride it up and down. So really, to not be in stocks, you have to believe in some form of extreme level of bearishness that says, well, we're going to go into an earnings recession and everything's going to be worse going forward. I was trying to read a summary of bear pieces and or like reasons to be bearish, and I found one. It was in a Goldman, actually in a bullish Goldman piece. we'll talk about it in a little bit, but I was curious. I'm like, okay, well, what's their bear case? And what they did is they basically put one little paragraph out for hey, like, look, you don't have to look far to understand the bearish narrative, so we're just not going to talk about it. See, so what they did is look at this. They, right there, for the bear case, talk to the person next to you. Geopolitics, Fed error, that would be over tightening or under tightening, debt ceiling, financial crisis two, recession, rich session, that's the white collar recession, credit, stagflation, commercial real estate, urban demise, civil unrest, rate cliffs, jobs, stocks versus bonds, blah blah blah. Bad news is in the ether and is priced in. And I thought that was really interesting. This wasn't a Goldman piece. That was actually a Bank of America piece. But anyway, point of this is really, it's like, yeah, there's no shortage of like this poop. But the thing that I keep going back to, and it's really what defined the Nike swoosh before before the Nike swoosh actually started becoming a reality. My thesis with the market, with the Nike swoosh, is that we would go through a volatile period of ups and downs, and that over time would look like 2022 was a down, and then you'd have your up, but that up would not be a straight up; it would be a volatile up. And my thesis supporting the Nike swoosh, before, just broadly zooming out from all of the data, was, when does the market feel more fearful, or when did the market seem more fearful? And I mean, now obviously we have the luxury of hindsight. As they say, hindsight is 2020. So it's but then again, we've talked about that Nike swoosh for many months. You're probably just tired of hearing about it now. But the point is, what was sentiment like? Think about this, like yourself for a moment. How were you feeling in September or August or October of last year relative to how you're feeling now? Now, that's a really important question. And I personally, I try to think about it. I go, well, how was I feeling? And the reality was not that great, because there was no bottom indication yet. There was no bounce off the bottom. We were still free falling, and nobody knew how far things were going to go. You had the Jackson Hole Summit. Before it, we had a little bit of optimism, but boy, oh boy, after that, not great. I remember when I launched my ETF on November 30th, December was actually a really difficult month because everybody was selling. It was like tax loss harvesting. And so it was really remarkable to see just how much bearishness there was. And to some extent, it made sense, because we're looking and saying, well, we don't know. Where's the bottom? Inflation hasn't gone away yet. Do we have any faith that we've actually hit peak inflation? And it's only now that we have this luxury of looking back that, and this is going to be remarkable to say it, but it just shows that when you're bearish, how quickly things can turn on you. Do you realize that it's almost been 1 year since we hit peak inflation? Think about it. Let me let that sink in for a moment. It's almost been 1 year since we hit peak inflation. We hit peak inflation 11 and a half months ago. In about 2.5 weeks, 3 weeks, we will be 1 year away from peak inflation. That's crazy. That's absolutely crazy to think that we are already a year away, basically, from peak inflation, especially since inflation's been so salient in our lives, and it's created. We've had so much, dare I say, fear about what's going to happen. Look, I guess my thinking in all of this is just that when you're getting a 5% yield and you're like, look at all this money I'm making on my cash, there's usually a reason. And I think that's the important lesson, is when you're making big money somewhere, it usually comes to an end, or it comes with some form of cost. And that's not a bad thing. Like, keep in mind, in certain cases, it absolutely makes sense to be sitting in treasuries. There are some companies that shouldn't be investing in stocks. They shouldn't be gambling in stocks. There's some people who shouldn't be gambling in stocks. Look, if you're a company that's going to be buying real estate, you should be in cash, right? Because still might not know what's going to happen with real estate. I mean, think about it for a moment. We could talk about real estate a little bit more in depth a little bit later, but think about it for a moment. The 10-year Treasury went from the banking crisis of 3.3% all the way to where it is now, basically at 3.7%. It's actually higher. My goodness, look, it's up again, 3.746%. So what's happening? Oh, interesting. The stock market's going up while yields are actually rising. Weird. Making real estate more expensive, putting more potential pressure on real estate. We're just now starting to get those year-over-year negative numbers. But we'll talk about real estate differently. Maybe somebody else who shouldn't invest in stocks would be, somebody who's retired, who's like, dude, I just want to lock in the 10-year Treasury at nearly 4% and screw it. That's great. I don't need any volatility of stocks. Just give me the money and I'll sit here and milk the yield. That's fantastic. But if you're, and this is my opinion, this isn't personalized financial advice. That should be obvious, but you never know these days. Everybody on the internet seems to get upset if you're not like super clear. But if you're 18, 19, 20, 30, 40 years old, 45 years old, 50 years old, and you're still going to be working for at least the next 10 years, either by choice or because you have to. If you're mostly just cash farming, you got to look and go, damn, screwed up for the first part of the year. Now, again, that's okay. I absolutely got back into the stock market way too early, right? So, yes, in hindsight, we could probably all have done something better. Now, my belief was that the stock market would pre-price in the Fed's U-turn. Remember when I sold, I said in January of 2022 that you want to get back in the market when the Federal Reserve U-turns, because the Federal Reserve U-turned in 87, February of 2009, December of 2018, March of 2020. You also had the March of 2003. I skipped over that one. But every time the Fed U-turned and marked at the bottom of the market, and this was sort of your broad shift in strategy, marked the bottom of the market, and the market did a lot better. That's obviously led a lot of people today to say, okay, but maybe that hasn't happened yet, and that means the bottom's still ahead of us. Or we know that the problem isn't actually fundamentally a broken economy, it's just inflation. And since inflation is basically peaked a year ago, people are like, well, as long as the economy can just get through for a little while longer and the Fed pauses, maybe we didn't actually overtighten. So long and short of it, my thesis was, okay, well, if the market comes to expect that the market rallies when the Federal Reserve U-turns, and the entire market knows that this time around, then what'll happen is you'll actually end up seeing the stock market recover before the U-turn under the assumption the U-turn is coming. And so far, that's what's happened. That's actually exactly what's happened so far, which is scary, but it also goes to show you could not have perfectly predicted that, oh yeah, in January, the market was just going to start rallying again and it would have stuck. There's no way you could have predicted it. Now, of course, there was this understanding of all the tax loss harvesters jumping back in. Sure, but nobody thought that would end up being sustained. So, it's really incredible. It's really interesting. So the point of that is it can't be perfect. But the other point of that is, if you're looking at your portfolio, it's like, yeah, I know cash was great in 2022, but boy, it sucked in 2023. That's also potentially another lesson, is usually the assets that do really, really well one year don't do that great the next year, because fund managers are trying to find alpha. Have you ever heard of the website Seeking Alpha? Yeah, that's because they're looking for alpha. They're legitimately looking for ways to outperform the market. That's what alpha is, your outperformance of the market, beta adjusted. Anyway, long and short of that, it makes sense to some extent that stuff that did really well one year isn't going to be the next pitched thing the next year. You've all seen The Wolf of Wall Street, right? Everybody's seen The Wolf of Wall Street. And what's fascinating about The Wolf of Wall Street is remember when what's that guy? Is it Matthew McConaughey? Yeah, I think it was McConaughey. He's like, you always have another idea. You never let them out of a trade. It's something like that, right? You always have another idea. That's how I feel like the real suits on Wall Street are, because they have to be. That's not to just bag on suits. That's just the business. It's like, all right, cash did really well last year. What do we think's gonna do really well this year? Well, you have to pick. Okay, great. It was tech and AI and stuff that was massively oversold last year. Could it continue to do well? Maybe, just maybe. I mean, we'll see with Nvidia earnings, which I think is propped on a pedestal right now, a shaky pedestal. But we'll have a video on that probably later today, not from this live stream, but I expect to make an Nvidia video later today. So sort of just an earnings preview video. But anyway, yeah, it's a really fascinating time and a really fascinating market. And I think it's always good to sort of self-reflect. The nice thing about you is, you don't have to be public with your portfolio and your decisions and your successes and mistakes. It doesn't matter. Celebrate your successes, forget about mistakes, and just move on and try to do better going forward. It's difficult now because it's like, now, and this is the conundrum. This is probably the hardest part. And I feel bad for anyone in this situation. If you've got a bunch of cash and you're like, all right, Kevin, you're right. Too much cash. Had too much cash. Well, do you buy stocks now? And now it's like, oh, well, anything can happen in the next, in the next few weeks here. I mean, ignore the debt ceiling for a moment. But I mean, just look at like retracement levels over here. It would be very easy for the NASDAQ to at least go back to 330 on QQQ, right? Which is your index for, or ETF for tracking the index of the NASDAQ 100. One of them. You could easily go back to 312 or, can you go back to 290? That's probably a little bit more of a stretch, but look, you've got some downside. Yeah, we could go up to 348, but so what's the upside? Okay, well, 348 divided by 337.64, you're at a 3% upside. 337.64 divided by, if we go to call it 312, okay, new number is 312 divided by 337.2, 7.5% downside. It would be horribly frustrating to go from cash now to like the NASDAQ and then it ticks down. But it'll also be frustrating to miss it if it keeps going like this. So it's very frustrating. And I think that's another lesson that we want to think about is when we're in cash, the hardest thing is figuring out, well, when do you pull the trigger and deploy? When looking at the stock market. Because you just don't know. Probably Vanguard says that statistically the best thing to do is lump sum invest. But psychologically, most people find it's better to take your cash, divide it into, let's say, 10 buckets, and just DCA, dollar cost average, those 10 buckets. So, you put one 10% bucket in, and then if the market goes down, great, throw in another 10%. Market goes down more, another 10%. Market goes down more, another 10%. Market goes up, maybe wait or go in, whatever, right? It's a really weird time, but I'm happy. I'm grateful that so far things are going well with this thesis. But I want to be humble enough to say we don't know what the next leg down could bring. Everybody's talking about a Q3, Q4 recession. If we get sticky inflation that encourages the Fed to hike more, or we have to basically price out the idea of rate cuts, then maybe there's some downside. If we really are going to have this earnings recession, which I feel like many companies already had, sure, maybe there's some downside. But I'm not convinced that an earnings recession isn't already built into valuations that we've seen here. The earnings recession seem to be most feared here. And it's almost like markets pre-priced in the bad earnings of 2023 here. They got out before 2023. And that's really what we saw widely. So now it seems to be okay, buy the dip on everything is what it feels like, which I understand to some extent feels like ludicrous. Gosh, like how Look at you keep buy the dip, buy the dip. It seems like a wild time to do that. And certainly last year was. This was, I mean, look at this. Okay, go back for a moment to 2009. So where's 2009? Oh, look, it's way. Look, I'm gonna zoom out on the month. Wow. Okay, we're gonna zoom out on the month on Weeps. Oh, it's gonna take. I should have just left it on the week chart or whatever. It'll come up in a sec. But anyway, your opportunity to buy the dip was fantastic between 2009 and, quite frankly, end of 2021. You could just buy the dip, and the market just went right back up within the next month consistently. So buy the dip worked for, what is that, 11, 12-ish years? And then you have one bad year, and all of a sudden everybody's like, buy the dip sucks. Buy the dip is stupid. Look at the YouTubers and their buy the dip mentality. It's like, yeah, buy the dip was a bad strategy in 2022. Abso-freaking-lutely. But wait a second. Wait a sec. Buy the dip was already back to being great in 2023. So now you look back and you go, is it possible that 1 out of 12 years is a bad buy the dip strategy? Well, I mean, we'll see. Maybe it'll be 2 years if this market ends up being a little poopy doopy, for longer. It's possible. But again, here's your chart. Look at this. I mean, it didn't matter what debt crisis. The debt crisis, the last debt crisis was over here. Can you even notice anything on the month chart? I don't know. Maybe it's a little flatter than you'd hope. Maybe you'd hope it was a little bit more of a perky chart over here. But I mean, like, okay, so there's 2018 when the Fed U-turned over here. All right. But other than that, on the month chart, other than 2022, buy the dip worked really well. So it's fascinating to me. So this chase, I guess, is sort of in summary on this part. The important thing to remember is there is a real cost to cash yield, and it's the cost of your opportunity. That's a problem. See this, and this is you know how many times I've heard this. I'm not blaming you. I'm not blaming you. I know you're just the messenger. Your name is literally the messenger. I appreciate you being a channel member over here, but this fear over election cycles, I've just never actually seen it be the catalyst for the stock market doing anything in particular. It was never an election that did it. It was the housing crisis of 2008, the dot-com bubble of valuation implosion. But then look outside of those, or COVID, right? But then you look outside of those. 2020 was a really contested period. Nobody cared. The stock market had like 2 weeks of heart palpitations. Oh my gosh, what if there's a contested election? Oh no. Nobody cared in terms of the stock market. 2016. Oh my gosh, Donald Trump won. If everybody's like, if Donald Trump wins, we're going poopers. Nope. 2008. Oh, if the first black man wins the presidency, that's it. We're going to the toilet. You never had a black man before. Only had a white man before. No, it didn't matter. Obama took office near the bottom of the market. Bottom of the market was like February or March. It was February of 2009. He took office Jan 21. I mean, come on. If anything, the elections help. So it's just, I think the news media has us convinced that there's always a reason to be fearful. Always a reason to be fearful. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced